Hi, welcome to February. We're going to talk about the Huntsville-Madison County Real Estate Market Report. This month we're going to look at confusing headlines, a top in mortgage rates, maybe, a bottom in inventory, and how that affects your home purchases over the next year. Let's check it out. Hi, welcome to the Huntsville Real Estate Market Report. This month, as we discussed, we're going to talk about confusing headlines. We're going to talk about a top in mortgage rates and a bottom in inventory. But first, before we get started, I want to mention this one more time. We talked about this last month. I want to take some pandemic anomalies and make sure that you don't have these expectations going forward. What we witnessed over the last 2 years were events in real estate that you'll never see again in your lifetime. Record year-over-year home price appreciation. We're never going to see 20% a year-over-year home price appreciation in our lifetime. Record low mortgage rates. Don't be expecting to get a 2.9% mortgage this year or any time in the future. Those rates were once in a lifetime. They're gone. We'll be glad when we get down in the fives, as we'll look at here shortly. And record low inventory. Hopefully, we won't see this again. We'll talk about why that's a possibility in the future, but we should not get down to the extremely low inventory we witnessed last year. Let's start out by taking a snapshot look at our market in Huntsville and Madison County. These are statistics from January from our Board of Realtors. You can see that sales are down, and sales are going to be down for this year. Down 27% January this year versus January last year. Most industries are predicting lower sales for this year because of the higher mortgage rates. We're going to take a look at those rates shortly. Average sales price year over year, however, is still up a little bit, 4% from January of last year. I always get a lot of comments that says don't look at year over year home sales. We're going to look at month to month here shortly. But just as a record, it's 4% year over year from January. Now that should approach zero as we go forward. And we might even see some negative year-over-year sales, but they should not be significant. Home inventory, market inventory is way up. It's almost 3 times where it was this time last year. But we talked about before where we're going to be short on inventory. We'll see how it compares to pre-pandemic levels. Days on market are still very good. 4 weeks on market is well below the historical averages. So we still have a very, very good sales market. Specifically, when we take a look at inventory, I want to take a look over the last year for Huntsville-Madison County, and these are single-family homes, not new construction. New construction really messes up your numbers because of days on markets and multiple factors. But you can see that the inventory is up, but it's still below the pre-pandemic levels. You can see our inventory bottomed last spring, where we had the lowest inventory ever, 1 or 2 weeks maybe of inventory on the market. And even though we're way up from there, we're still well below the pre-pandemic levels. So inventory, I would say, is still low. It has been increasing. We talked about a month or 2 ago some things that are limiting our inventory, and we're going to take a look at those again here shortly. Existing home prices in our market, remember, we price homes price per foot. Every market doesn't do it that way, but in Madison County, that's the way we do it. So if you're going to look at home prices, you need to look at price per foot, because that's not affected by the size of the home. Like if you did a median market price, it would be. You can see that our price per foot peaked last spring, around $169 per foot. Again, these are on resale properties, existing homes, and we're down to about $162 per foot currently. So over the last year, approximately home prices per foot are down about 4% in Madison County. And that's about what you're looking at nationally. Obviously, there's some pockets, just like there always are, that are significantly more, some that are a little bit less, but there's no crash that has occurred, no crash on the horizon, but prices have softened over the last year. The big story is mortgage rates. As we talked about last month, the big story being the doubling of mortgage rates in 22. Well, if you can look over the last year, you can see that big jump over the last year in mortgage rates. And what we believe has occurred is we believe we have seen a peak in mortgage rates around this 7% level last fall, September, October, November. It was bouncing up the 7% level, and it's down about 1% since then, as you can see. Now, it's ticked up just a little bit in the last few days, but still well below the 7% level of last fall. And if you'll recall, you can take a look at this trend as it continues on this chart. This is the 30-year mortgage rate down to 6.09%. It's at maybe about 6.2 now. But we think that trend is going to continue. It's obviously going to be choppy, moving up and down, but it's very likely that we have seen the top in mortgage rates. And if you remember, we said before that historically mortgage rates are going to peak before the Federal Reserve stops raising the Fed funds rate. Well, they're still raising the Fed funds rate. Last time they raised it lower than they have the previous times, but they still probably have some rate increases ahead. So at some time in this period, we would expect mortgage rates to peak, and it's very possible that they already have. Now, when we're talking about mortgage rates will drive demand for housing. Always has, and that's the primary driver for mortgages, is how affordable is it for someone to buy a home. Well, this is a chart that's been created based on today's current mortgage rate environment. And you can see that when mortgage rates got over 6.5%, we had very limited buyer demand. When they were peaking last fall at the 7%, we almost had no buyer demand. The market really froze up. Froze up for first-time home buyers, froze up for move-up buyers and investors as well, as mortgage rates just got too high too fast. But recently, this year, we have been in the green zone, good buyer demand. We've been between the 6 and 6.5% mortgage rate. We have noticed locally better buyer demand over the last month and a half than we had last fall. We have had some homes. We still have some offers that are getting multiple offers on some properties. Homes have been discounted. We're still having some discounts on existing homes. We still see some discounts on builder spec inventory that we'll talk about shortly, but we're in a good area for buyer demand. Now, the point that I want to make here is that if interest rates have peaked and if they continue to decline through the year, we're going to drop down into this lower band of 5.5% to 6%. And if we get a solid 5.75% mortgage rate, we're going to bring a lot of people back into the market. So some people ask me, is it a good time to buy? Is it a good time to sell? Now may be a good window for buyers because you don't have a whole lot of other buyers out there giving you competition. You have more inventory on the market than you had a few months ago. But if you wait a month or two or three or a quarter or two and those mortgage rates do settle in the mid-5s, we're going to have a lot more buyers in the market chasing this inventory. And this little bit of inventory increase that we've seen over the last few months can be dwindled away very rapidly. Headlines are doing more today to terrify than clarify, and that's always been the case. A recent study by NerdWallet found that 2 out of 3 people say that we're going to have a housing market crash in the next 3 years. And if you only read headlines, or if you only look at real estate 2 or 3 times a year, and you see headlines like these, I can understand why you would feel that way. U.S. foreclosure filings surged 115% in 22. Foreclosure filings rose 115% last year. Well, that sounds terrible. And if that's all you see, the first thing you're going to think of is, oh my goodness, we're going back to the years of the Great Recession where housing prices crashed, and I don't want to be a part of that anymore. Well, Adam is a leading data supplier for title companies, mortgage companies, closing offices across the country. And it is a fact that foreclosures rose 115% over 2021. But it's also a fact that they were down 34% from 2019. And even more importantly, they're down 89% from the levels that we saw in the Great Recession back in 08, 9, 10, and 11, which is the most recent memory people have of a bad real estate market. And as a matter of fact, for most of you watching this video, that's the only bad real estate market you've seen in your entire lifetime. And you're probably not going to ever see anything like that again as well. I have this chart up from time to time, but it's updated now for 22, and you can see that there's a bump up in foreclosure filings for 22. Remember, back in 20 and 21, during the pandemic, we had some moratoriums on foreclosures, so that kept the foreclosures down, but those have all been lifted now for at least 6 months and some for as long as 12 months. But the point we're making here is even though we had an increase in foreclosures last year, we are so far away from the foreclosure environment that we had back in the Great Recession that there is no way that you can see a housing market crash on the horizon. You can't have a housing market crash when you don't have homes to sell. when you don't have high inventory, when you don't have high foreclosures. So I just think if you're waiting for a market crash, you're going to let this market pass you by. If you're going to wait for 2 or 3% interest rates, you're never going to get back into the market. But I think this year is going to be a good time to be looking at your real estate investments and moving up in real estate again. It is possible that we have seen the bottoming in home prices. Now here, we talk about year-over-year home prices, and I understand people saying, don't look at that, let's look at month to month. Well, here's month to month for home values so far this year. And this is a lagging number. We've only updated through November. They come out 2 or 3 months behind. But you can see that home prices were steadily rising at the beginning of last year. January through June, every index had home prices in the plus. But then starting last summer, as you notice, when rates were really taking off, home prices started not to rise, and they also started to fall month over month. But the point here is that their month over month declines are decreasing. So it's very possible that home prices are starting to stabilize. That's what we're going to look at this year. And that most of the decline may be behind us. In our market, in Huntsville, Madison County, our market action index, that shows us how the market is doing. It tracks the velocity of sales. We're still in a slight seller's market. But if you've been watching us on a regular basis, you know that last summer this thing was peaking out at 100 when we were in a very strong seller's market. It's still a slight seller's advantage. We're not to a buyer's market yet, but it has slowed down quite a bit over the last 6 to 12 months. What's coming up next? This is what we're looking at for 2023. Mortgage rates have peaked, we believe. I was going to put a question mark there, but this is a forecast, so I'm just going to go ahead and say mortgage rates have peaked. I don't believe we'll be back over 7%. We may test that 7% if you do charts for stocks or bonds. You know that sometimes you have to go back and retest those highs. We may retest that 7%, but I do believe that's going to be our peak when we get a year down the road and we look back. We look for home prices to stabilize. Their month-over-month declines are decreasing. In our market, you can see that the homes have dropped a little bit, but not significantly. Inventory is going to remain a challenge. We've talked about before how investors got really scared when their rates doubled over the last year. We've had a lot of investor activity back in the market beginning this year as rates have come down. We've had some builders providing incentives for investors with lower interest rates, which has helped them move back into the market. Homeowners who have mortgages at 4 or 5% were very reluctant to put their home on the market and move into a 6 or 7% mortgage. But if interest rates get back down in the 5s by the end of the year like we expect, then those homes will also provide some additional inventory for the market. Builders are converting from building spec homes to building pre-sales. If builders have spec homes on the ground now, we are getting some good incentives. They have reduced prices. They're also giving incentives like paying closing costs, providing refrigerators, blinds, those type of things to move those spec homes. But they are going to be building fewer spec homes and going back to a more pre-sale market like we had pre-pandemic. And we're going to return to pre-pandemic normal conditions. That means a normal 3 to 4 to 5% a year appreciation on real estate, a normal seller's market or buyer's market or balanced market where buyers have some choices, sellers make some concessions, we get reasonable prices for sellers, reasonable terms for buyers, and that's what we're looking for in the future. If you have any questions about your next real estate move, check us out. We have a lot of resources for you. The descriptions are in the bottom of the video. Please call us if we can help you with anything, and let's have a great day.